today we have among us Saket Mehrotra, who's a fund manager at Tusk Investments. Is known for sharing his knowledge with clarity. He also manages family office, and he also runs a newsletter that goes by the name of Beta to Alpha. So basically, he's a strong proponent of free markets and talks about positive sum games, which we will be asking him during the course of this session. And again, he write very good threads about investing, and those who are not yet seen those, and they can directly check his handle and gain so much of insights from his experience. So Saket, welcome. Any opening remarks from your
Thank you so much, Prince. No, I'm glad to be here, and yes, a lot of what you mentioned. That's basically what I've been doing now for quite some time. I think it's sort of. I was always around in the world of finance, so one thing led to the other, and I'm glad I was finally able to get into doing this full time for a living, because it allows me to sort of balance everything, right from reading to trying to learn new things every day, as well as keeping my touch with the world of finance. So that's something which sort of uh, knits all of it together.
That's great, great. So our first question is always around the market journey. How it started for you, Saket, and what was the moment which made your passion it as your passion, or to say your profession? How you have progressed over the learning curve in this journey so far?
Yeah, so I'm sorry, like the voice got stuck in between. You asked about the journey, right?
Yeah,
That's what
how
your
it
question was.
started for you, and what was that moment when you think like it will be a full time profession for you?
Sure, sure. So, as such, I didn't really have any plan or agenda that I wanted to get into this right away. Obviously, when I started my career, I was always around the world of market. So, my dad, like, he's a retired lawyer, so he used to trade stocks. And in my house, you had annual reports coming in, and CNBC used to sort of play all around. So, yes, maybe growing up, I was always around these things, but uh, I mean, I would say the interest sort of started when I I worked with ITC for a year. This was like pre CA. I was interning with them for a year. That's when being a part of a strategic planning team inside corporate finance. One of the core work or core roles and responsibilities was to track competitors on a daily basis. So there were reports that were made for the senior management, right from down to, like, let's say, tracking the daily share price movements, to if there's any news or quarterly or any let's say corporate announcements, etc. And that's when we also sort of, let's say, on a regular basis, we would benchmark the quarterly results that come out, and sort of do an do analysis to sort of see how things are moving. So that's when I really, you can say, started reading between the lines and try and understand how to really look at what's relevant and what's not. At that point, there was some interest that rose because up until now, yes, while there was one element of reading by the book, and before that, I would intern in a CA firm, so that was more around how to maintain books of accounts and how to sort of record keep the right way. So I think it sort of tied together. This was again back in 2014, 15. Uh, Obviously, after that, after clearing my CA and CS, I again got an opportunity to work with ITC. So I was there for around 4.5 years. And then that's when, obviously, because I was involved in the treasury function, so there was some element of the markets always involved. But at the end of the day, I think during COVID, things accelerated a little faster. I would say that's when I sort of took up the whole thing of writing online very, or maybe I had a lot of time and space to really think it through, and I started publishing my thoughts and writing them. I had been reading quite some time on investing and annual reports and whatnot. But that, I think at the end of the day, writing sort of helped me tie all of the things together, and that's how. maybe you can say. And obviously, after that, I changed two jobs again. And finally, I got to work in the buy side where, I can sort of take active fund management decisions on a daily basis. So that's, sort of to sum it up very briefly, is how I got into this.
Interesting, Saket. So, Saket, you talk about positive sum games. Can you elaborate a bit for us?
Sure. I think what most of the people think when they, let's say, do something or partake in something that, or let's say for the longest time, I mean, the difference. So it's like this, right? So there's something called zero sum game and there's something called positive sum game. Now, zero sum game is something where, let's say, if I win, you have to lose, right? Or let's say if you win, I have to lose. That's what a zero sum game is. Positive sum game is where, let's say, if I share something with you, you gain something out of it. And then, let's say, you share something with me and I gain something out of it. So, both of us, through, let's say, some form of exchange or some form of activity, sort of gain something from each other. That's basically what the concept of a positive sum game is. So, a large part of me writing online has to do with the fact that at one end, it, let's say, helps me give a logical conclusion to my thinking process when I have a final output. At the same time, I start getting feedback from people, whether it's good, bad, very good or very bad. And that also helps me refine my thinking process or gives me perspectives from different things. It's one thing to sort of like have a view and think of, let's say, uh, a certain thing in a particular order. But when you sort of share that with the world and let's say you tell it to five other people, you will get five different perspectives. Now, whether you need to stick to it or whether you need to apply it, that's a different scenario or a question. But that basically is what I meant by positive sum game. So whether if I have to collaborate with someone, if I have to write something, if I have to get some perspective about something from someone, I think that's something that is really a thought that has helped me get better outcomes. So it's something that I have sort of become a bigger fan of rather than trying to look at the world in a very binary scenario where you always think there's a winner and a loser.
Right, Saket. So, Saket, sorry. So, if I ask you about your investing style, so what is it like? You go by value, or you look after growth investing, or what momentum, or what exactly is screen your stocks, and what is the thought process behind that?
Sure. I mean, first things first is, you take a perspective on whether, and I'm both a top down and a bottoms up guy, which basically means that if I like an industry, if I see there are tailwinds, so the one approach is you finalize on the industry, then the company, then the sector, and then the company, right? And the other is also a bottoms up approach where you first look at a company, you see whether the earnings growth is kicking in, whether the company is making free cash flows, and if there is a sense that there is longevity of those free cash flows, given that, okay, the industry is going through a change or there are some great tailwinds in that space. So, when you sort of take, I mean, obviously, I take both these approaches, whether it's top down or bottoms up. And I mean, at the end of the day, if I feel that, and value investing or growth investing again can be very subjective, right? So if I feel that, okay, a certain company can grow at 30%, and let's say you can have a view that this company can grow at 10%. So for me, that can be growth. For you, it can be value, right? Uh, and at the same time there could be a high possibility what you find valuable, I might see that, okay, there's an element of growth involved because let's say a certain business will start making cash flows after 2 years, or let's say a certain part of this company has still not been discovered, or you really believe is something that can change or can really sort of exponentially contribute to the company's earnings. So the framework that I typically follow is, I mean, you look at the sector, you see whether, who exactly is sort of dominating in that sector, and if that person is listed or not listed, then sort of skim down. Uh, and then at the same time, from a bottoms up approach, you do your due diligence, you see whether the company has earnings growth, whether the company is making free cash flows, does it have a good return on capital employed, and then I mean, okay, one can ultimately take a call whether they want to buy it. I mean, it again depends on what view you have, right? So most of the investments that I would typically want to look at will have, let's say, a 5 year or a 10 year view, unless, let's say, some risk event materializes or something fundamentally changes, so you have to take a hit and get out. So when you have that sort of view and perspective, I think I mean, yes, at the end of the day, valuations do matter, because if you don't buy something cheap, at the end of the day, maybe uh, you might not be able to make money on re-rating. That's also a school of thought. But mostly for me, like, these two things are very important. One is the industry should have tailwinds where it allows the companies that operate within the industry to grow. There should be predictability or some degree of certainty in how, let's say, the cash flow growth is going to kick in. Obviously, there could be some external shocks here and there, but you sort of play those scenarios out in your head. And finally, do you feel that the company has a strong management team or a robust franchise in terms of, let's say, demonstrating that they can grow their earnings and keep generating free cash flows?
Right, Saket. So, Saket, you talked about top-down approach. So, any two, three sectors you think 2, 3 years down the line ought to do good, or you see some tailwinds across those sectors?
Yeah, so I mean, in terms of sectors, I feel technology, or let's say the way, let's say, we consume technology today, or use technology on a day-to-day basis, that's something which has always interested or intrigued me for the longest time. So when you take that view or approach, right, the first and the foremost take would be, should I buy the pipes, which is, let's say, a telco company which is providing you that data service. uh, if you drill a level further, a derivative play could be whether you want to buy the platforms. So for the longest time, I've always had a very bullish view on Facebook, or let's say how Meta as a company has these various suite of products. But somehow, a lot of risk events materialized with Meta. Whether, let's say, Apple sort of pulling out with not allowing Meta to track cookies, so that makes the whole ad targeting mechanism almost worthless in 30% of the world's devices. Or let's say the whole metaverse bet or the multiverse bet that they are making, that's something which investors are sort of not liking at that moment right now. And there's still another 60, 70 odd $1 billion that they want to pump in. Uh, and again, finally, WhatsApp, which is a product that all of us use, but somehow right now there are more questions around how that's going to get monetized. So then, I sort of went a level further and said that, okay, I mean, all of us use Instagram and WhatsApp on a daily basis. What exactly are we using it for? So then the third leg that came in was that, okay, we consume a lot of content here and there. So at the end of the day, who's making money from all this content consumption? So then you look at content IP owners. So that's, let's say, how I sort of zeroed down on a thesis to play the whole internet consumption by looking at, let's say, one of the biggest or the oldest owners of IP when it comes to content IP in India. So that's how I took, let's say, a top-down approach to looking at things.
Right. So, Saket, can you tell our audiences what could be a good portfolio building approach, how to position size, and people are often confused about averaging up or averaging down. So, how you go about it, and what should be an ideal approach to it?
Yeah, so I think to be very honest with you, there's no definition or there's no said scientific procedure to do it. I mean, obviously there are, let's say, some AMCs, and obviously there are regulated products. Let's say when you look at a ETF or some of these mutual funds which have mandates. So at that level, they have to be very scientific in the way they, let's say, reduce or increase their weights. But for a retail investor who's managing his or her own portfolio or his or her own investments, or even from an allocation perspective, right? I think at the end of the day, if there's something that you feel you have rock solid conviction in, right? So let's say For me, like the example that I mentioned, right? So Facebook went from, let's say, 320, 30 odd dollars to almost 150, $160. It almost halved, right? At that point, you always have this question in your head. Something which, let's say, you bought at 100 and it's now 50. At this point of time, if you really have the conviction, this is the time to double down, given the fact that, let's say, you have capital available to deploy. At the same time, if something sort of exponentially goes from, let's say, 100 to 200, do you feel that it's okay to take some weight off and, let's say, maintain that weight? So that's something which is very subjective. It depends on A, what is your level of conviction, and B, what sort of capital allocation opportunities you have. Because at every given point of time, you will always have better opportunities, and you'll always have, let's say, opportunities which you feel may not give you the kind of returns you want, let's say, at that particular point of time. So I think it ultimately, I mean, averaging up or averaging down basically has to do with two things. One is what sort of conviction you have on a particular stock or a sector. And one part obviously has to do with, let's say, what research or what homework you've done. What is it that you know that others don't know? Or what is it that you believe can happen, which others might not take even notice of, right? So that goes a long way in deciding whether you want to average up or down. At the same time, what happens is, no matter what your conviction is, no matter what your research is, even the best of the best people in this whole industry, when they see prices, go for a toss, and especially on the downside, when something that you bought has corrected 50%, suddenly you sort of start realizing, or questioning things, and you get this price action bias in your head. Have I made a mistake? Is this something which I'm holding alone, right? Or am I going to get down? Because there are enough instances like this for us to sort of keep feeling or keep thinking this way. So I think conviction goes a long way. It could be through your own circle of competence, or through your own, let's say, sector or domain expertise that you have, or something that you've observed growing up. So that goes a long way. And the other thing which people, more often than not, don't talk about a lot is what sort of capital constraints do you have, right? Because in theory, everything looks great, right? You keep buying the dip, you keep buying the dip. But at the end of the day, all of us have finite capital, whether we have 10 rupees, whether we have 10 lakhs, or whether we have 10 crores. So that is something which is always a constraint. So then comes a second sort of line of thought where, okay, instead of this, do I have a better opportunity, or do I keep, let's say, doubling down on, let's say, my existing ideas that I have? So that, I think, is sort of what should decide how you level up or level down. And yes, if there is a company, or let's say if there's a particular stock that you like, and if you have, let's say, 5% weight in that stock in your overall portfolio, even if the stock does really well and, let's say, doubles in 2 years, your 5% probably goes to 7.5, 8, or 9%, right? Because the other portfolio also changes here and there. So even after having conviction, even after having your research or homework, uh, that ultimately matters as to how much sizing or how much allocation you're doing to that, right? It's like saying, let's say, a lot of us in India are obese, right? I mean, forget India, even in the whole world, a lot of us are not that fit. But if I say that, no, I want to take fitness seriously, and if I'm eating burgers every day, not sleeping on time, and not working out, then, it's not walking the talk. So the same thing applies to sort of maintaining or allocating how you size your positions. So it's very important that you put the money where the mouth is.
Saket, I think we lost you. We cannot hear you. There?
Oh, till when or till where did you hear me? Sorry, I'll just then repeat
Yeah,
from there.
last 20 seconds we missed on it.
Yeah, so basically what I was saying was, I was trying to put a fitness analogy to it, to sort of say that, okay, if I want to get fit, I mean, let's say in one place, if we say that, okay, I want to get fit, and on the other end, if we are like eating a lot of junk food, not sleeping on time, then it's basically, saying something and doing something else. So one has to walk the talk. And when it comes to position sizing, the principle remains that you put the money where the mouth is. So that's quite important in terms of allocation or position sizing, as you asked. Yeah. Are you there, Prince?
Yeah. We all make mistakes. So, in your journey so far, Saket, which are the mistakes you want to highlight and what you learned from them? That would be very helpful for our audiences.
Oh, sure. I've talked about these mistakes a lot of times. In fact, my first article that got published on money control was on let's say 10 investing mistakes. But I'll just highlight a few, and these are pretty basic, or it sounds quite intuitive, but been there, done that. So the first mistake was obviously getting into leveraged trading uh, very early, right? And sort of blowing up my whole portfolio. Maybe I think I've blown up my whole portfolio one or two times very early in my career. And there was like a considerable amount of savings involved that I had managed to save after working in my first job. So that is something, and I did this by sort of violating all the rules of not taking stop losses, not position sizing, or keeping sort of averaging the losers and all of that. So that's something which I have burnt my hands with very early, uh, when I started my journey as a CA. So that's number one. Number two, when I got into this whole idea of investing for the long term, picking stocks, trying to read numbers, uh, I think at some level this is something which, if you're an investor who's not doing this full time, if you're doing it out of your hobby or passion, that's a different thing. But even after knowing everything, there could be a possibility that you know nothing about the stock, right? So for anyone who's sort of trying to get into investing, or just starting out, I'm a big suggestion or a big feedback that I would have for you guys would be, don't just go picking stocks directly. Maybe start with a few ETFs or a mutual funds. See how compounding works. See your money grow, maybe for 2 years, 3 years. And then, if you really have some deep conviction on a particular stock or a particular sector, then try and pick your brains on what is, let's say, a better bet or what is not. So that's number two. Don't go for direct stocks right away. Maybe try and understand, or do this whole passive route where, let's say, if you're earning 100 rupees, you think you're not earning 100, you're probably earning 90 or 80, and you set up your SIPs automatically from your bank account. The money goes, and you sort of chill, right? And that's truly how compounding really works. And how I got to understand this whole theory is also quite interesting. So I had a friendly broker in our family, and basically, when I started working, he sort of set up my whole account, and he was like, "Okay, let me set up a SIP for you uh, on one ELSS." I was like, "Okay, fine, do it." I didn't even check which scheme that money was going in. Turns out it was one of the worst performing ELSS consistently, right, for amidst the whole pack. And yet, when I saw that whole thing after 4 years, 5 years, it still gave me a CAGR of around 14%. And this despite it being the worst possible ELSS in the whole category. So the lesson that I sort of learned from that whole episode was that compounding can really work wonders if, let's say, you're not looking at it, right? I think I read this quote that I mean, the best investors are probably the ones who are dead because they never saw, or they probably didn't know that where money was lying, and it just kept growing, and that's that. And finally, one mistake which I've also talked about it a lot is that sometimes you can have a very bullish view on something. You will feel that, okay, this will play out, A, B, C will happen, and you will make money on an outcome. There could be a high possibility that those things do not play out, right? So if you do a, let's say, a scenario based investing where, let's say, a certain company has announced a certain capex plan or a certain new line of business, maybe don't go very aggressively on that unless you have a view that, okay, whatever they'll do, it'll happen. So maybe wait for some time for them to walk the talk and see whether this is something that's really taking shape. So jumping in early on, let's say, something which has come up, that can also sort of backfire to you, and especially if you end up allocating a higher sort of allocation or weight to that whole thing. So that is something which has blown up on my face multiple times. But over the years, maybe a edge that I was able to develop, or you can say more than the edge, it was more like a learning or a risk mechanism tool that I was able to develop, was that okay, I had a mental stop loss in my mind that if it hits, I get out, no questions asked. And okay, 4 out of 5 times it has worked in my favor. In one occasion, it went the other way. So I think these are the three, I would say, top mistakes that I've had and have sort of helped me evolve to be a better learner and a thinker. So that's what I would have here to share.
Right, Saket. Saket, I see you often talk about biases, right? So, few biases you would like to talk about today. We all do have a certain kind of biases, right?
Oh, absolutely. I mean, whether it's the fact that, I mean, there are all sorts of biases. Maybe if you do a Google search, you'll get like probably thousands of biases that exist. But I think, uh, I mean, a big part of how we operate as human beings or individuals has a lot to do with greed and fear. Whenever a stock corrects, we'll start questioning everything, whether this is really something, whether there's something wrong, if there's something that's not working in our favor. And whenever a stock keeps going up, the whole greed takes over, and then you think that okay, this party is here to stay. I think in the recent times, especially the new cloud of investors who got uh, in the last 2 3 odd years, they have seen massive recency bias. They've seen Nifty. I mean, you've seen benchmark indices move from 17 to 8 and back to 17. Like these are the kind of movements that happen over a 10-year or a 15-year period, and people have seen it happen in 2 years. So that I think is gonna go a long way in anchoring people to believing this is something which happens over a year. But so obviously there's recency bias, there's anchoring bias, because you feel that that's there. And finally, something that again is an extension of this whole greed and fear uh, thought that I have, has to do with the loss aversion bias, or let's say the sunk cost bias, where something has really gone down the drain and you still feel there's hope. So you end up averaging that loser again and again, despite knowing very well that nothing's going to happen here. So that's something which always has happened, I think, to a lot of us here. So that is again a bias that plays out multiple times. So yeah, I think these are, let's say, the 3 or 4 biases which I've seen multiple times play out.
Right, right. So, guys, I have one last question before I open the floor for questions. So, anyone who has any question, they can directly send in a request or they can type in the comments so that we can take up that question with Saket. So, Saket, the sell decisions are the most difficult ones. So, do you have any framework when it comes to selling, or do you also use technicals per se?
Yeah, so not a big user, or I would say I use technicals very sparingly. Almost, let's say, 1 or 2% would be the overall contribution of technicals, but that's also something which maybe I'll learn or develop in due course. Not something which I want to do right away. But as far as the selling framework is concerned, I think number one is, if you expected to invest in a company that makes, let's say, and this is just an example, right? So let's say you wanted to invest in a company, or let's say you bought a company, or you bought a stock or a business that's into, let's say, QSR, right? And they sell burgers, and suddenly you see that the company is setting up a steel plant. So that's obviously a big red flag for me, because I wanted to buy the burger business. I may not know anything about the steel business. So that's number one. So basically, if you bought a company for doing X, and if they start doing Y, which has nothing to do with X, there is prone to be gyrations, or there is prone to be, let's say, capital misallocation in the short term, which as an investor I don't want to buy into. So that's one. Second is, if I see some, let's say, valuation madness going on, so something that you've bought suddenly goes up 6x, 10x, 20x, maybe it's a good idea to take some weight off. So maybe if you allocated 10%, maybe take 5% out, maybe take 6% out. A seller never loses. This is something which my dad keeps telling me all the time. But again, that's something which maybe I've not been able to really incorporate very effectively in my day-to-day framework. And finally, so the first thing was unrelated diversification. Second thing was on let's say selling. I mean, something going up really sharply in the midterm. And in the past, I've also had instances where something went down very significantly, and maybe I was not able to read on something. So obviously there were blind spots, so that did not work out. And finally, if there are any accounting or corporate governance issues, right? So let's say if there's something malicious happening in the company, there's some legal case that suddenly comes up out of nowhere. So that's something as an investor I would not want is shocks, right? So unless if it's something which is being done out of malice or something in which the company has nothing to do, but there's always, as the saying goes, there's no smoke without a fire. So I would say these are the three broad parameters where I would typically try and base my sell decision on.
Great, great, Saket. So, Saket, we when it comes to banking and financials, people are often of different opinions. Some are saying that they have done well in last 1.5 hours, and they might not do good in days to come. Whereas one section says that banking and financials will do well for next 3 to 5 years, seeing the good balance sheet and all. So, what's your take on that sector, and how you see it panning out from here?
So, in my own personal portfolio, I have over indexation on financials because the thing to note in financials is yes, I mean, for any country to grow, I mean, see, first and foremost, it's very important to be on the same page in terms of expectations. So, if you feel a country is going to grow at X percentage, right? The credit growth in the country has to be close to 1.2 to 1.5 times of that percentage. So let's say if you and I believe that India is going to grow its GDP at, let's say, 10% for the next 5 years. So credit growth in the country has to be anywhere between 12 to 15% for us to sort of support that GDP growth, because a lot of underlying growth also happens on credit, right? So that's one part where you talk about credit sort of flowing to enterprises and the whole space in the corporate world, or let's say for businesses to take up. The second element is that of aspirational consumer debt. So we today are at a point where we've crossed the call it, let's say, the Lakshman Rekha, or a resistance of the $2,000 USD GDP per capita. And what happens is once this sort of gets crossed, and obviously for any country to prosper, the GDP per capita has to keep increasing. Uh, the consumer preferences move more towards aspirational, and you know, and it has got a lot to do with what the age demographic of the population is. So when you look at the 10 to 24 cohort in India, that is the largest in the world today. So no matter what happens here and there, this is the cohort which will want to grow, which will want to have aspirations about living a better life, about upgrading to the latest gadget, about buying the latest, I don't know, smartphone or car. And a lot of that will not happen immediately based on their incomes, right? Because the GDP per capita sort of paints a different picture. But at the same time, as Indian consumers or Indian individuals, we've always been very risk averse. So even if we look at our own personal balance sheets, it's not that we have a lot of unsecured credit or unsecured debt lying in our own personal balance sheets. In fact, whatever debt that you will see in an Indian household balance sheet, a lot of that has to do with the fact that it's related to mortgages, right? So the point that I'm trying to make it, on one end, where you will see corporate credit growth kick in, if we you and I have the view that okay, we expect India to grow at X percentage for the next 5 years, 10 years. Enterprise credit growth is something which will have to sort of work hand in glove with that. And the second part is the aspirational consumer credit. So whether it's upgrading your electronics at home, upgrading your smartphone, or this whole concept of lifestyle creep, where whenever incomes rise, in order to live a better quality or standard of life, you also upgrade things around you. And maybe a lot of that may not happen immediately because of the incomes that you have. So yes, that's where credit sort of comes in. So who's going to give you that credit? Again, it's going to come through the whole financial space. Again, as a business, financials is something where the input and the output is money. So wherever you will see a lot of money being involved, it's prone to a lot of uh, risks around, let's say, mismanagement or corporate governance. So that's where you again go back to the drawing board and see which are the players or which are the banks or NBFCs where you feel credit quality is robust, management has a squeaky clean track record, and that might translate into you paying a higher multiple to buy these institutions. So that is what the whole view is.
Right, Saket. So, Saket, any sectors which you are bearish on or maybe not looking at this point in time, maybe due to some headwinds or maybe the valuation thing?
So, obviously, and this has got nothing to do with headwinds or valuations. I have not been able to, let's say, track the specialty chemical space. That's something which maybe I would probably want to do in due course at some point of time. But it has got nothing to do with any headwinds or valuations, but more to do with what I have on my plate and limitations on how many things I can read at one point of time. So that's there.
Right. And Saket, there are like what we say talks of recession around the globe. So, do you see that panning out, or our market will be resilient to the changes happening in the global landscape?
So, not really an expert on how the whole global macroeconomic scenario evolves, but the limited read I've had, at least on, let's say, some of the headline numbers coming out of US, is that they have something called the HPI, which is the Housing Price Index, which tracks the house prices in the US. And at some level is sort of cooling off. So you can't have a scenario where house prices are falling down and your interest rates are going up. Obviously, the labor data and the unemployment numbers were not really something which came out very favorable. But the point being that yes, everyone sort of knows that interest rate hikes are here to stay, cost of capital is going to go up, everything sort of is baked in. But somewhere I feel that we can't have a scenario where we see prices going down and interest rates going up, right? Because for you to sort of spur housing demand, you need to ensure that cost of capital is effective. So I don't know how that whole interest rate movement is gonna happen. Maybe I'm not a big buyer of what's gonna happen or what's not gonna happen. I think these are things which are out of our control. We really don't know what a country is going to do tomorrow, whether X or Y will happen. Then obviously there are bigger problems to worry about. But I think without reading too much into noise, if you can sort of keep keep your head down, think things through, and have a longer term view, you will see. I mean, 2 years back, who would have thought that after 2 years, things will not move for 6 months? Or let's say, we'll have this whole epidemic and suddenly A, B, C, D will happen, which we've all lived through. And now we are back to living a normal life, right? So I think in the long term, these things really don't make a lot of difference. Tomorrow, if recession happens or doesn't happen, I mean, no one knows what's going to happen, right? So all people can do is, I mean, I can say recession will happen. You will say recession will not happen. I will have a view. You will have a view. And at the end of the day, let's say if it happens, okay, you win. If it doesn't happen, maybe I win, right? Again, we're going back to the whole zero sum game argument. So that's what I said, right? My focus has always been more on what are the positive sum outcomes rather than, let's say, what zero sum outcomes sort of take you through. Because at the end of the day, there's no end to the kind of speculation you can do to really see what will happen or what will not happen.
So, Saket, we are almost time which we discussed. So, last two questions, if you can take. One is in the DM. The person is asking your views on Bajaj Finance, and second, any book recommendations after that. Yeah,
Sorry, what? My views on what? It got stuck in between.
yeah, Bajaj Finance from here.
Yeah. So I keep getting that question a lot. I mean, my views fairly sort of remain the same. There's a detailed video which I recently done with Ishmohit. It's there on the SOIC channel. One can check that out. As I said, right, if you heard the discussion around credit growth, the reason why I like Bajaj Finance a lot is that it's a big play on this whole aspirational consumer credit growth that one foresees, or I mean, they've already demonstrated that for the last decade. Here on and out, if GDP per capita really goes up, that's something which one can sort of look into. So all of that is covered in that view. Secondly, I would say, as far as books are concerned, see, I mean, at the end of the day, to be very honest with you, beyond a point, it doesn't matter. I mean, okay, books always give you a good perspective and, looking lens into looking at things. But what you do from that book becomes more important, right? So, for example, maybe I've never read The Intelligent Investor, but maybe I've read One Up on Wall Street, Beating the Street, Unusual Billionaires, right? So it's a more Indianized context book. But the lessons which are there in those three books, right? Which, let's say, some of the takeaways that I've had from those three books, I still apply it to on a daily basis. Whenever, let's say, if I have to look at scuttlebutt, if I have to look at uh, assessing the longevity of earnings of a company, whether I have to really see they have pricing power or whether they'll be able to meet the ROCE, which is higher than cost of capital. So that becomes more important, I would say, rather than how many books you read. So I think, there are plenty of recommendations there. A mix of 5 or 6 books should be great for you to get started. And yes, once you get into this habit of reading, you will get you will keep on getting better recommendations, or you will find your genre of a certain writer or a certain category of books that you would want to read over the long term. So it's more a personal journey. It's like saying, what cuisine should I eat today? I mean, I don't know. Maybe I like to eat Chinese. So if I say that, hey, why don't you try fried rice? For all you know, you might be someone who's a bigger fan of North Indian food, right? So you may never like the Chinese food to begin with. So I think it's a very personal thing. Yes, I mean, what are the best sellers. In fact, I always try and go back sometimes to brush up on my basics as well. So recently, Deepak Shenoy uh, wrote this book. I'm forgetting, it's called Wise Money, or something. No, I think Wise Money, Wisest Owl was written by
Money
Anupam.
wise.
Money Wise, yeah. So I read that book. It was a great read. I was on the flight and I completed the whole book. But what insight I got from that book was this whole fiasco that happened around UTI AMC, which was something that I had never heard of. I may have heard my dad talk about it at some point of time, but after reading that, I was able to connect. So that I think would be my take on book recommendations. And I mean, Twitter is filled with uh, sharpest and brightest people talking about book summaries, takeaways from books, etc. So you will find your way. Is what my answer is.
Great, great. So, Vajpayee ji, any inputs from your side, any question or maybe any remarks from your end for today's session? Okay. So, Saket, any closing remarks before we close? And it was great to have you today, and it was very insightful. And for the knowledge of the audiences, this session is recorded and will be available at our handles. And apart from that, I'll be placing this podcast over my YouTube channel. So you can revisit, or those who joined late, or maybe due to any glitches, they couldn't hear at times. So they can always revisit the insights of learned people. Yes, Saket, over to you.
No, I think this was a great session, Prince. Thanks a lot for hosting me, and thanks a lot to listeners for tuning in and listening to us patiently. I think a lot of questions you had were quite well rounded, and I'm glad I was able to, share whatever I know about this whole world. So thanks a lot for having me and for hosting me in your space.
Thanks, thanks. Pleasure is all ours, and it was really nice knowing. And the idea is to learn from various experts so as to add to our knowledge. And basically, this Twitter ecosystem is helping us big time. And guys, I highly recommend the threads put in by Saket. It is They are so diverse and so full of information, and even the newsletter also. So you guys can check in, and always it is always good to have good insights, and that surely adds to your investing journey. And as Saket is very vocal about these positive sum games and biases, so these also help us to cut on the don'ts of market, and which itself is helping us to remain with the do's in the market. So Saket, thank you once again for your time, and surely we will try to have some other day as well. And it was great to have you today.
Sure, sure. Thanks a lot, Prince. Thanks once again for listeners for tuning in. Uh,
Thanks,
Thank
thanks.
you.
So, guys, if you are liking our work, kindly follow our handles so that we can connect with the knowledge we share, and also any future spaces you will be notified. Thanks again.